Good afternoon, everyone, and thank you so much for joining us today. My name is Brianna Mosher with the Flint Genesee Group, and today I have with us Brooks Kendall from the Michigan SBDC Growth Team. This is the second installment of our Talent Matters webinar series. As we are well aware, nation talent-wide shortages are at a 10-year high with no immediate end in sight and no one-size-fits-all solution. To challenge businesses and organizations to think creatively about the way that they develop, attract, and retain talent, the Flint Genesee Group has kicked off this series, which launched last month. Today, we are going to be talking about succession planning for business owners. If you are thinking about selling your business or retiring, this is the place to start. If you are looking to open a business, there might be an existing business out there that you might think of buying. So we see in the last several months, a lot of people are pivoting from what they were currently doing to really what they see themselves doing. And so this could be an opportunity for that as well. Brooks, I'm going to hand it over to you to start your presentation. If you could just introduce yourself too, talk a little bit about the growth team and what you guys are all up to, that would be great.
Sure, thank you. My name is Brooks Kendall. I'm actually over in Grand Rapids today, where the weather certainly would provide justification for wanting to sell a business and move somewhere south. I've been with the SBDC for about 10 years. I'm on the growth team, and we work with primarily second stage companies with 5 years in existence, 10 or more employees, and revenues north of $1 million. Growth team is comprised of a group of specialists. We have an attorney, a CPA, some recovering bankers, people with expertise in organizational development, marketing, social media, branding, finance. The focus of my particular consultancy is succession planning, business transaction services, and financial management, strategic planning. The SBDC, for those of you who are not familiar with us, is a statewide resource. There's actually an SBDC in every state. The Michigan SBDC has regional offices around the state, and we serve all 83 counties. We're funded by a joint operating agreement between the SBA in Washington, the Michigan Economic Development Corporation in Lansing, and the various universities that host our regional offices. And because we are supported with taxpayer dollars, all of our services are at no cost to clients. In addition to that, everything we do with clients is protected by federal law, so everything is confidential. We have basically 5 teams. We have an export team, which helps businesses who want to grow through exporting. We're very heavily into the cybersecurity space, working with clients on how to protect themselves against that. Our regional center teams are comprised of consultants who work primarily with startup and small businesses. The growth team, which I'm on, works with the second stage companies. And we also have a team, a technology team, which works with companies who have sort of the gee whiz exotic university research type things, advanced materials, biomedical devices, and so forth. We provide one-on-one consulting, market research, 149 clients around the state. And we also provide a lot of training and business education through workshops, both in seat and online, such as today. And we have a profound impact on the Michigan businesses. Last year, for example, we were involved in $302 million of capital formation, number of businesses started, jobs created, and worked with over 11,000 clients. So enough of our commercial message. The mission today is to talk about how to sell your business and what is your succession plan. So we're going to talk about what are you selling, what is it worth, what is the universe of potential buyers, and how do you find the right buyer for yourself? How do you work with a broker? An important aspect of selling a business is the advisory team, and what is your succession plan? And do you have a succession plan? What are you selling is really critical. there are businesses that we refer to as lifestyle businesses. And I was working with a client last week. It's a great example of that. It was a woman who several years ago decided to take and make mittens out of used sweaters. And she would design different patterns and cut up the old sweaters and sew them into mittens and sell them for a very nice margin. And she was the one who did the design, initially did the manufacturing, but she's outsourced that to a seamstress. And she does the selling and goes to trade shows and so forth. It's a great example of a lifestyle business, and she makes a nice living at it. But from a buyer's perspective, what would they be buying when this particular individual was not only the creative side of the business, but also the selling side of the business? Are you simply selling equipment? Interestingly enough, and with the supply chain shortages and all the disruption that we've had in the economy lately, there may be an interest in buying a business just to get at its equipment because you can't get new equipment. Are you selling real estate? Are you selling intellectual property, the secret sauce, the gee whiz of how to do something? Or are you selling a book of business, which is a group of relationships with customers, a particular target market or a geographic market or something like that? And what you are selling has a great deal of influence in defining what a logical buyer would be. Also, another aspect of what you are selling is what your runway is. In other words, you woke up this morning and we're under flood watches and we're expecting sleet and all sorts of things. And you say, hey, I've had enough of this. I want to sell my business and move to Florida. I'm sick of winter. Well, that's fine. But if it's like, I want to do this now, basically you're talking about a liquidation, unless you just happen to get lucky. Generally, you want a 3 to 5 year runway in order to get your business ready for sale, to sell it at the maximum price. So your timeline, what you're selling, has a great deal of impact on how this goes forward from here. Obviously, what is your business worth is an important aspect of this. Value is a function of many things, but it really boils down to cash flow and risk. And cash flow can be quantified. When you get involved in this, there may be adjustments to what your income is based on excess compensation to the owner or above market rent or other things which a buyer would not continue with. So you can come up with what a business is generating in terms of free cash flow, but the risk part of it is more subjective. And you need to think of risk as a continuum from a risk-free investment, i.e. like a treasury obligation, to a very risky investment, which would be like a distressed business. And each business is different, so the earnings multiple that a friend may have received for his or her business is not an indicator of what your business is worth. And so it's important when you are trying to determine what your business is worth, you have several choices. One is you can get an appraisal from a credentialed professional, or at least a scratch pad valuation from perhaps your CPA or something we do at the SBDC as well. Given that, it's worth noting that what a buyer is willing to pay for a given business is really a reflection of that buyer's perception of risk and what the buyer's required rate of return on their investment is. Because you may be selling a business which may have been your lifeblood, your baby, your everything. It can be a very emotional thing. The other side of the transaction, though, is a buyer who is simply looking at, I'm going to put so many dollars into this business. I hope to grow it. I hope to make it more profitable, and I want to get a return on my investment. And the odd thing about this whole what is a business worth discussion is that banks have a very different approach to it. If you have ever seen a credentialed professional's appraisal, it's probably 30, 40 pages. And on the first page, they talk about the purpose of this is to determine at what price a willing seller and a willing buyer would agree to a transaction. And then they spend the next 30 pages or so telling you why it's a different number. And so if you're going to be buying a business and working with the bank on getting financing, you have an additional problem because the bank will look at the appraised value, which I had a situation where a willing buyer and a willing seller, I think, valued a business, if my memory serves me correctly, $1.1 million. And the appraisal came back at $800,000. Well, and the bank in turn will discount that somewhat and say, well, gosh, I'm only going to loan you $650,000 on this. Well, now you have a gap between the $650,000 and the $1.1 million, which they'd agreed to, which technically from the bank's perspective is goodwill and therefore has no real value. And in addition, the bank is going to rely on historical performance. And which is an interesting thing because often somebody who started a business, a number of years ago and has grown the business and perhaps, kind of running out of gas a little bit, thinking about retirement, doesn't have the eye of the tiger that they used to. And somebody comes along interested in buying it who is perhaps younger, more energetic, has ideas to grow the business, do things to make it more profitable, generate more cash, and so forth. The bank really isn't interested in that. They're going to look historically at the business. So what a business is worth is really a combination of what a willing buyer and seller can agree to and what a series of numbers, both from a cash flow perspective and a risk assessment, would determine its investment value, if you will. So what buyers are out there? You basically have two types. You have internal and external. I was just on a webinar this morning from the Family Business Alliance, which is a tremendous resource for family-owned businesses, and talking about dealing with multiple generations and all of the family dynamics of a family-owned business. But that certainly can be one way to transfer ownership is to children. You can also perhaps sell to one or some group of employees, perhaps the leadership team. If you have a partner, perhaps the partner would be interested in buying you out. And I certainly hope if you have a partner, you have a buy-sell agreement with the partner, which defines the terms at which one partner buys out another partner, and most importantly, the formula by which that valuation occurs. There are also two primary external type of sales. One is to a financial buyer, and that is simply somebody who has X number of dollars. They see a business that is going to provide a certain return on investment, and it becomes really not much more than a portfolio type thing to them. The biggest value you're going to get for your business comes from a strategic buyer. And a strategic buyer is someone for whom you have something that they don't have, desire to have, and have determined that it's better or cheaper perhaps to buy than to try and recreate. So that can deal with technology, it can deal with geography, it can deal with a book of business, a variety of things. But somebody for whom the acquisition of your business complements what they do and increases the sum of the parts. The value is greater than the sum of the parts. So how do you find a buyer? Well, if it's not an internal sale, there are really primarily two ways. One is you can talk to your attorney, CPA, industry associations, whatever. The risk of that, however, is that then it's now public information, to some extent at least, that you're interested in selling your business, which may be fine. You may have an attorney or a CPA who has other clients who may be interested in buying a business, or individuals who perhaps have taken an early retirement package from a large company and aren't ready to retire and have a nice fat retirement nest egg and are interested in buying a business to run. So that certainly is viable, but you need to be a little careful, if you will, about the word getting out that you're looking to sell your business. The other main way that people do that is to hire a business broker. And why hire a business broker? Well, they're market makers. Business brokers are aware of people looking for businesses. They have means of qualifying potential buyers, and they will help you maintain confidentiality. If you've ever worked with a business broker, you know that the first thing they're going to do on the buyer's side is to qualify them. So they're going to determine the person's financial capabilities, their ability to not only provide a cash infusion, but their bankability if there's going to be bank financing involved. Assess their expertise and knowledge of running a business, perhaps specific industry information. So one of the broker's main features is they're not going to have people bringing you people who aren't capable of concluding a transaction. And until the potential buyer signs a non-disclosure agreement, the broker won't be sharing any confidential information with them. So those are the two major ways that you can find that buyer. How do you find a broker? Well, you can talk to any others who have sold, friends, family, colleagues who have sold their business, get referrals that way. The Michigan Business Brokers Association is a great resource because you can see brokers that specialize in particular industries and understand the experience and capabilities and so forth that they have. And I would encourage you to interview several brokers and ask about fee structure. Get a handle on how active and busy they are. What is their previous 12-month listings and sales? It's one thing to list a lot of companies, but it's another thing to get those companies sold. So you're very interested in both. How they go about working with you on pre-due diligence, which is basically taking a hard look at your business and determining, first of all, any issues or concerns that a buyer is going to uncover and perhaps remediate those. You'll want to know how they go about marketing your business, the way they use a non-disclosure agreement to protect confidentiality, and what kind of listings, ads, other communications they use to get the word out there that you may have a business for sale. Another really important part of selling your business is to have an advisory team. If selling your business is not something you can do by yourself for several reasons. One is you probably don't have the expertise necessary from a tax, legal, valuation perspective and so forth. And second of all, you have a business to run. And the most important thing you can do when you are in the process of taking your business to market is to keep focusing on your business. Keep it running and running as well as you can. So an advisory team would logically include your business broker, a transactional attorney, and CPA. And what do I mean by transactional? Attorneys and CPAs and doctors have specialties. And so if you were wrestling with, say, a brain tumor, you would probably want a neurosurgeon to work with rather than your family doctor. Attorneys, you have attorneys that specialize in estate planning, divorce, intellectual property, a variety of things. And so you want an attorney whose specialty is business transactions. And the same with a CPA. CPAs are involved in taxes and assurance and all sorts of things, but a CPA who understands the nuances and the tax implications of a transfer and ownership. For example, there's a methodology by which a transaction can occur where the seller elects it's called a Section 338H10 transaction, where the seller can treat it as a stock sale and get capital gains treatment, and the buyer can treat it as an asset purchase and therefore allocate the purchase price back to the assets. So that's a very specialized bit of knowledge that you want to have. Valuation professional, we've talked about that. Hopefully you're a client of the SBDC, and we certainly can help on this. And keep in mind your personal professionals who handle your financial, estate, and tax planning, because it's important that the business advisory team and your personal professionals are sharing information and coordinating things in such a way to protect your interests, to let you walk away with the most amount of after-tax, after-fee cash as possible. So it's often said that business is a team sport, and selling a business is certainly a team sport. I can't see you, but I'm wondering if any of you have watched the HBO series Succession. It is a very interesting series about leading characters in the HBO hit series Succession. For those of you who have not seen it, the HBO show follows the Roy family, whose patriarch is the head of the world's largest media and entertainment company. Logan is the head of the family, and as he gets older, it is clear that someone will have to take his place. He has 4 children: Connor, Kendall, Shiv, and Roman. And to say this is a dysfunctional family is an understatement. They're fictional, but pulled from real life for inspiration. Logan closely resembles Rupert Murdoch, who founded News Corp, and given their occupation, Murdoch children has 6. And for a while, it seemed like 3 of them were going to take over the media empire once he retired. And that was because they were each part of the business at different times. And it's the same thing with the Succession TV show. You've got these 4 kids that are involved in aspects of the business. But they also, both in the case of Rupert Murdoch and this fictional family, were forced to handle huge scandals on how their business has been conducted. So what does this have to do with selling my business? Because there are certain principles that determine the saleability and value of your business, whether you are a global behemoth or a small business. So what can we learn from Succession? Well, the thing that's most obvious about Succession is that it's a hub and spoke organization. What do I mean by that? Well, Logan Roy is the family patriarch. No decision is made without his knowledge and approval. And so if you think about it from the standpoint of a buyer, if you're going to buy a business where the owner of the business owns the relationships, has the technical knowledge, makes all the decisions, is large and in charge, what are you buying then when that owner sails off into the sunset? So one of the things that's really important in terms of lessons learned from Succession is that you really need a leadership team who can work independently and run the business, either if the owner wants to go to Florida for 3 months in the winter, or hopefully the owner is working from a strategic perspective on the business, not in the business. There are additional challenges with intergenerational transfers. And boy, that comes through. you get the family dynamics involved in a business with children who may or may not want to be part of the business, who may or may not be qualified to be part of the business. That can get very messy. There's a lack of a vision and strategy in succession. Basically, it's just this giant money-making enterprise without a real coherent vision of where they're going and how they're going to get there. And clearly there was a lack of a succession plan. There was no grooming of the children to take over or logical way to get them involved in the business. And lastly, it really is a great view into what the impact of having a dysfunctional leadership team and a flawed company culture has on business value. So, one of the things that I hope you're going to take away from today is that you really want to spend some time and effort preparing your business for sale. In order to maximize the value of your business, there needs to be some work done on mitigating risks and doing the things that make it attractive to a buyer. At the SBDC, we are certified value builder advisors, and the value builder program was a result of a book written by John Warrillow called Built to Sell. And the premise of that book is that when you start a business, you should think about the end game. At some point in time, you're going to want to exit the business, no matter exiting to whom, but you're going to want to exit it. And you want to do the things that will result in making your business the most saleable at the highest dollar value at a time and place of your choosing. And in this book, he has quantified 8 value drivers. These are the things that make a business not only the most saleable, but the most valuable. Obviously, financial performance is one, a history of growth and earnings and free cash flow. Probably that is one of the most important of the 8. Probably the most important of the 8 would be the hub and spoke, which I spoke about a minute ago. To have a true leadership team that can run the business if there's a change in ownership is hugely valuable. Growth potential. Nobody's going to buy a business that's in a declining market. Switzerland structure is all about not being dependent on any one customer, vendor, or employee. One transaction I did a number of years ago at the SBDC was about a $10 million business. And when we were doing the analysis, we determined that no customer was more than 7% of their annual revenue. Obviously, the risk then of having an adverse impact on that company, if that 7% customer leaves, is very marginal. Whereas you have some companies where 50-60% is one customer. And should that customer leave, or even something as mundane as the purchasing agent at that customer leaves, a new one comes in who has other relationships, that's risky. Valuation teeter-totter is basically a kind of a crappy way of determining if your business is a cash spigot or a cash suck. In other words, is your business generating free cash flow or is it consuming cash? Recurring revenue, the easiest way to think of that is the Gillette razor blade thing. Are there things that your business can do to generate recurring revenue? I don't know, maintenance contracts, licensing agreements, whatever. Monopoly control. How hard is it for somebody else to come into your space? Think of it as a moat around the castle. How difficult would it be for somebody to establish a business like yours, provide the same products and services to your customers? The customer score is really how satisfied your customers are with you, and that's focused on the Net Promoter Score, where do your customers recommend you to friends and family? So what is your succession plan? Do you have one? The statistics show that very few businesses do. And statistics also show that only about 20% of the businesses that go to market are actually sold. And so I think it's very important that you spend some time figuring out how you want to transition out of your business. And we can help you with that. We can help identify the things that you can do to improve the salability of your business, to reduce the risk of your business, and to help make it an attractive business for somebody to buy, hopefully at a premium price. And so that is the end of what I have to say. If you have any questions, would be delighted to entertain those now. And if you would like to get a hold of me and talk offline, those are my contact information.
Thank you, Brooks. I have had Succession on my list of shows to watch on HBO. So thank you for reminding me about that. Now is the time to ask your questions if you have them, and Brooks will take a look at those. I have a couple of questions to get us started, though.
Sure.
In thinking about exit planning, when I talked to Christy and Janice to plan out the content of this webinar, we started talking about ending when you start. So when would you say is too soon to begin your exit planning strategy? So maybe I am just hitting that growth period in my business, but in thinking about the longevity and sustainability, is it something I should be thinking about this early on?
Well, it's never too early to start, but I think the general rule is if you are 3 to 5 years away from the point at which you would like to exit your business, that's an ideal time to start working with an exit planning professional.
Okay, very good. And you mentioned an interesting statistic: 20% of businesses that go to market are actually sold. Why do you think that is? Is it because they're coming a little too late in the game, or?
Well, it's a variety of reasons. First of all, some of them are lifestyle businesses, like the mitten maker example I had. I mean, there's really nothing to buy.
Mm-hmm.
There are also businesses where they have not been run well, and from a financial investment standpoint are unattractive. They're highly leveraged. You also have the issue that in some business owners view their business as a way to minimize paying taxes and do everything they can to minimize income, which is fine. But then when you want to convince somebody that this is a cash cow and worth a lot of money, that can be a difficult challenge. You can have businesses that are simply too small. There's not enough mass there. Other businesses, obviously there's an obsolescence. I mean, the classic example everybody hears about is Blockbuster Video. I mean, a business for whom technology in the world moved on. So
I think there is still one standing.
Yeah. And quite frankly, simply people aren't planning to sell their business, and then all of a sudden, they have to sell. Somebody gets sick or dies, or 101 things happen, and then it becomes a liquidation, not an orderly sale.
Right. And I think sometimes, in a family business, it's almost assumed that a child, a grandkid will want to take on the business, and that's not always the case, what we see. What would you say are the pros and cons when it comes to selling versus just closing? Certainly, we hate to see businesses close up shop, but why would someone do that versus exploring selling?
Well, I don't know. If I had a business, I would certainly like to see if I could extract some money out of it in transferring ownership. A colleague of mine, I remember several years ago, was talking to a dentist who said, I'm going to retire and I'm going to close up my practice. And long story short, never thought about selling his practice, and ended up selling it for, I think it was $500,000 or something like that.
Wow.
So some people may close their business not being aware of the fact that there's something there of value to sell. Hopefully they've done the things they need to do to make it a saleable business. But there again, that's something that working with some advisors, whether it's the SBDC or your accountant or whoever, it's a conversation you should have. Should I close it? Should I have an auction and auction off equipment? Should I go to the effort of taking it to market? That's a good question and discussion to have.
Yeah. We have one question that came through. Christy, happy birthday. Thank you for joining us today. She asked, can I just go to a realtor to list my business for sale, or is there a difference between a real estate broker and a business broker?
Yes. A real estate broker sells buildings or homes. A car salesman sells cars. An insurance salesman sells insurance. A business broker sells an entity, a business comprised of employees and customers and vendors and all of the stuff that goes into a business. And while a real estate broker may be incredibly gifted in real estate transactions and real estate law and market comps and all of that, that is not a transferable skill to selling a business. Not only because what you're selling is different, but who you're selling it to is different.
All right. Thank you for that, Christy. And again, happy birthday. We are hoping that you are enjoying your 2/22/22 birthday today.
Buy a lottery ticket.
Yes, buy a lottery ticket or go to the casino. That's what I told her. We don't have any additional questions coming in at this time, but I do want to show this information again. So I dropped a couple of links in the chat, Brooks, while you were presenting, so that folks know how to get a hold of you and the SBDC team. An incredible resource right here in our backyard. So you can learn more about the growth team, find Brooks' contact information, as well as the rest of his team here at this link. Brooks, any outgoing comments that you'd like to make for those who are watching?
Yeah, make a plan.
Make a plan. And I really like this idea of exploring what's out there already before you decide I'm going to open a business, because someone might be looking to sell, pass down an existing business in the same market that you're looking to open in. So definitely worth exploring.
Yeah, you may have heard of the silver tsunami. That's a word that's been bounced around the last few years. But there are, first of all, a lot of baby boomers that are, want to sell their business. There are those who have gone through now the recession of 2008 and our pandemic and have said enough.
Yeah.
I've had it. But then there are also a lot of people for whom they're not interested in working in corporate America. They want to have their own business and have the financial wherewithal to buy it. So from everything I've read recently, the business transactions market has been very robust in the last year or so. So there are a lot of businesses coming up for sale. There are a lot of transactions that are being consummated. And there is a ton of cash and liquidity looking for a good investment. So if you're interested in buying a business, it's a great time because there's money out there for a good investment. Work with your team of advisors to find that gem and put a deal together.
Great. All right. Well, thank you so much, Brooks, for joining us today. If you have additional questions, please feel free to reach out to SBDC directly. Brooks, do you want to put your slide back on the screen with your individual contact information?
Sure.
There we go. All right. If you have individual questions, please feel free to reach out to the team at any time. And again, Brooks, thanks so much for joining us today.
My pleasure.